Good evening, all. We'll let a few folks kind of come on in, but thanks as always for joining. Roland, what a pleasure to have you up here.
Nice to see you.
Nice to see you too, man. How are you?
Everything's chilled today. Just
Yeah.
enjoying the markets. Just watching and waiting.
I think that's the most prudent thing to do, Roland. Very well said.
Well, I'm very fortunate that my Fridays have paid off 2 weeks in a row, and so I'm kind of enjoying that. I actually might have actually caught on to something new in my process. So I'm being very mindful.
Well, that's good. Why don't you elaborate? Why don't you kick us off?
Um, I don't know what happened other than I'm seeing more of the market. I'm seeing more what's happening.
Okay.
And that inspired me to just upgrade to Macro Pro just from HYG
Oh, nice.
Live, from
Yeah.
being able to do more, do better, and just watching the risks and rewards and the iVol premiums and just keeping track of it.
Nice. Nice. That's good.
Yeah,
That's
still organizing.
no,
Yeah,
but that's what it's all about though, right? I mean,
especially the
and
notebook. Yeah, especially organizing that notebook.
it is helpful. It is helpful if you when you know where to go, right? When you know where to go for the when you see something on the screen and you know you wrote it down or you know you wrote, whether it was today, yesterday, last week, the week before, and you can go reference it. I'm a big fan of having stuff on the screen and in Excel and all that kind of stuff, but there's also something to be said for that tangible, note in the notebook. And yeah, man, I'm glad to hear that. I'm glad that it's going well, and that's it's really good to hear. It's great to hear that you're being able to see the board or the field or the ice, whatever terminology you want to use. It's great to hear that.
Yep.
Yeah. Uh, well, good. Well, Trend, welcome, buddy. How you doing, man? Doing well?
Yep, doing well.
Good, good, awesome. Well, we'll kick things off here, and welcome everybody to another week of the Notebook Review. Always a pleasure to be your host, and we got a lot to dive into. Got a lot of notes here I was able to kind of put together to review. So I think it's a very important time right now in just in the marketplace in general. There's a decent amount of noise, right, in terms of folks calling for just further downside, upside, what does that mean, and all that kind of stuff. And what I'd really say to that is sort of just block out whatever makes you more confused and just focus on what Roland's just echoed, which is focus on kind of what fits your game, right? Fits your investing style, fits your focus, your goals, whether it's it's always great and cool to talk about the quick trade you made, but really at the end of the day, what we're here to do is to preserve, protect, and compound our capital. And whether that means being 80% cash, 100% cash, 5% cash, that's up to you in terms of what you want to accomplish and what you feel comfortable with and what you're seeing on the page and on the board. So that's kind of what I'll start with is just be take a hard look as to like what makes you tick, right? Like if it gives you anxiety to try to be watching the screen and catching every move or picking the bottom on TLT or oil or the list goes on and on, right? Qs, whatever it might be, then just take a breath, right? Go for a walk, reassess, right? There's always time to kind of come back to the screen, come back to the page, come back to the notebook. The what's on the horizon is very likely a Q2 earnings disaster, right? Once folks are actually coming out and reporting that, there could be something in between now and then. That's kind of basically about a month away, where there could be a lot of noise here, right? So just take that with for what it's worth, and with that, I'll pass it off to our usual guy who leads us off, the one, the only, the Trend Wizzo. Hopefully that wasn't too preachy, Trend, but I just had to get that off my chest.
No, it wasn't preachy. Definitely,
Good.
worth just a good revision
Just a reminder,
overall.
right? I mean, this is what we're here
Yeah,
for, right? This is like we're
yeah,
here
yeah.
to not look at what happened, right? Not look on the oil move that you either missed or got into or whatever, but look about what is going to transpire, right? We're trying to position ourselves for not only Friday, but next Friday and the 3-month Fridays from now and the end of the year. You know what I mean? So like that's
Yeah.
that's the goal of this, right? That's the goal of this session. It's not about
Mm.
revisionist history. It's about how do we prepare for the next play? How do we prepare for the not even the next play? It's really the next game, right? How do we prepare for the Patriots in 3 weeks, or the Kansas City Chiefs in a month, or the Miami Dolphins might be an easier play, an easier game next weekend, but it's all those things in between, or maybe the Jets. Hopefully we don't have many Jets fans, but yeah. Anyway, Trent, I'll pass it off to you, my man,
Sure.
and get us going. So thank you very much as always.
Yeah, yeah. So last week was interesting between last Wednesday and this Wednesday. We obviously saw extreme volatility across the board. There was literally no sector left behind. Energy took a sharp beating on the 1 week momentum. It has actually turned negative, but crude oil has not yet breached the 96 level. So we'll have to see how long this downward draft continues. I think in the after hours today it was at a 104. A lot of late longs are being forced to liquidate in that. Couple of sectors of note which were positive were healthcare, still holding the uh, baton to a certain degree, but it's been negative on the 3 month and 1 month momentum. And that, along with real estate and staples, were trying to show some sort of resilience, which are the classic defensive sectors. Not the real estate, but staples and healthcare definitely are the classic defensive sectors. And amongst the international ones, I was short on the Austria one. It continued to provide downward um downward draft, EWO. And then same with a few other names such as France and Germany. They continue to provide a similar wave. What has been interesting, I think last time we discussed about Bank of Japan, their action. Gavin had asked me about yen. Yen continued to decline, and in a profitable way for us, right? So that's where sometimes when folks discuss narratives on forex with me, I'm always like, no, forex is the best market along with commodities to just follow the signal. If you follow the signal on forex and commodities, those two are going to, you don't have to read any headlines for that matter, right? After the fact, you can always justify that, hey, Kuroda is doing this and Bank of Japan is doing that, or they have exceeded the balance sheet as a percentage of GDP as compared to Swiss National Bank. Doesn't matter, right? At this point of time, the yen momentum continues until maybe at some point of time it wouldn't. But until then, I want to be in that trade, right, as a trend following person. And similarly, on the rates front, I actually did not do much activity. So, and I know Gavin usually has a good take on rates. I let him focus on that. Australia, I've been short Australia since last week as well. Australia and New Zealand. New Zealand shorts don't work out in decent quantity or size for me usually, and I haven't found a easy way for doing New Zealand shorts through options because those are extremely illiquid. There's another one which I'm watching to continue pressing short on is India INDA. I'm waiting for a pop up in order to go short on it, but the signal is giving pretty strong signal on the downside. So, having said that, from a pure cross asset perspective, I think in the bonds market we're going to see some degree of relief to a certain degree, but we have a very busy FOMC member speaking session, so that induces some degree of volatility at times, and especially post OPEX and uh, going into the month end and quarter end and everything. We might see some sort of a sideways chop. Uh, so I'm not super negative in terms of my negative exposure. I was able to degross myself. I still so these are things that have been working so far. Now, what's not working, right? I shared last time my merger arb portion was not working. Fortunately, there was a little bit of bounce in Citrix systems when they did the EU filing showing or indicating or hinting to the market that, hey, the deal's not off. You're going to continue to have the deal go through. Same with a bunch of other merger up positions, which started where the merger up spread started narrowing. I think what would be interesting is when actually one of these deals closes, that's when you'll start seeing all the other ones trying to, they'll start narrowing further. But until then, until the next one closes amongst the ones that are open, and there are a bunch of them open, especially on the cash acquisition ones, it's going to be an interesting play so far. So, having said that, I'll give it back to you, Rob.
Yeah, good points, and a little backwards looking there, trend, but that's okay. I'll allow it. No, but on that FX component, I think it is important to just make a note in terms of where the top end of the risk ranges are on some of those pairs, right? So if you look at the CAD USD, look at that top end of the risk range and kind of look at where we've come. And I just would sort of encourage you to kind of review where that is in terms of, what, just again, just kind of from a price momentum standpoint, what does the currency need to do, whether it's CAD USD, Euro USD, where do we need to land in terms of to kind of,
Yeah.
for them to potentially gain some price momentum, right? So Euro USD, it's on my screen, it's kind of knocking right on that door. Call it 106. A hair under that is kind of that level to regain kind of 1 month sort of trade momentum. USD CHF, so that would be the Swiss franc. That's already kind of regained some trend now. I know Coach is short the Swissy, and really he's anticipating kind of a mean reversion back to the norm, right? So, again, just be cognizant though, just because he hits the button doesn't mean that you have to execute in that moment in time, right? So he's conveying what he's seeing, what he thinks is the highest probability kind of trades and outcomes, but you're still at your own mercy in terms of making that decision in those times. So, again, just the top in the risk range, for instance, on the euro US dollar is it was, as of this morning, 1.065. So again, you see that, and you can see that it's a bit, it would be above kind of 1 month kind of call it trade momentum. And just things to be cognizant about when you're either putting that you're a short back on, maybe you're keeping it on a bit of a tighter leash than you would have last month or 2 weeks ago, just because of everything is transpiring. So again, just the dollar's absolutely been gangbusters. It's plus 9% year to date. But again, just kind of be cognizant of where that is. And with that being said, I'll kind of relay that over to one of the things I wanted to talk about today, which was something along the lines of 2 weeks ago is June 8th, right? So that, that was 10 days ago. That's basically when the day after that, on the 9th, is kind of when we started to see a lot of assets prices fall off, right? So just keep in mind kind of what that quote unquote reset looks like from a price momentum standpoint. Those lower levels can get kind of reset, right? So just with time, that 10-day momentum, it shifts. It basically shifts down, which means that recapturing that 10-day momentum again. We don't love moving averages, but I'm just going to use it from a kind of a more general standpoint where a lot of folks understand moving averages. That component can be recaptured much more easily at a lower price point. So just kind of keep that in mind. With all that said, there's massive lower highs across the board. If you look at the SPX, the NASDAQ, the Russell, from the risk ranges, the trade ranges from June 8th versus June 22nd, you're going to see huge lower lows, right? So, sorry, big lower highs.
Right.
So, and lower lows, really. Well, likely, I didn't write down the lower lows, but likely lower lows too, but definitely lower highs. The SPX, for instance, it was 42.28 2 weeks ago. It's now 38.43. The Russell's 1941 versus 1743, and the Nasdaq's 12,496 versus 11,601 today. So again, could we see mean reversions or possible moves to the upside, absolutely, it's probable. It's part of the math. And you kind of saw that in that IWM risk range, the refresh one from the RTA yesterday from Keith. That was a trade basis. So that top end of that risk range, go compare that versus what the risk range was on a trend basis within ETF Pro, right? And so I'll just encourage everyone to go look at that. Go look at the top end of those risk ranges on a trend basis and look at like where we came from, whether it was June 8th or 1 month ago, 3 months ago, and just kind of take an assessment, right? Because that's really, it's math. So it's possible that we go to the top end of the risk range. And now, is it probable, or is it the highest of probabilities? That's that's kind of, that's what we're all here to try to figure out, right? But
Right.
some shorts definitely look stronger than others. XLF, for instance, looks stronger than XLY. And so yes, just wanted to kind of point that out and just make that was one big assessment that
Rob,
I saw today. Yeah.
Just to clarify, so you're saying that the XLF short has higher probability of working as compared to XLY, but is that compared to the usual standard deviation move of one standard deviation move of XLF, or is that compared to the absolute move of XLY?
That's more, I'd say, more from a signal standpoint, right? Like if you're looking at, if I'm looking to,
Relative to itself,
if relative to its
okay,
relative to itself, XLF, not in its spot right now, but sorry, relative to each other, XLF in regards to the signal to me is weaker than XLY, right? So XLY has, basically the top end of the risk range is certainly on that from the ETF Pro. If you go look at that, that'd be a new, I'm almost positive it's a new 1 month. It would be a 1 month high. 1 second, let me just double check that. Yeah, it'd be very close to a 1 month high. And it'll, as of tomorrow, it'll, 2 days from now, it'll be a 10-day. Well, it's already a 10-day, but it'd be a 10-day and a 15-day high, would be the top end of that risk range. So you're just right flirting on that, right? So with a little bit of time, if that top end of the risk range remains the same, then that signal doesn't look as good today as it did 2 to 3 weeks ago to a month ago when we were trading at 168 and 170, 165, what have you, right? So if you're looking for shorts,
but XLY looks much weaker in momentum terms too as compared to XLF. That's why I'm not understanding. Are you saying XLF is weaker compared to its own prior momentum,
XLY, I mean, come tomorrow, that recent 10-day high is going to come down, right? So it's going to move down to, just north of about 150 or so, right? So that's all of a sudden with time, it's been trading in a band over the last few days where it's not going to take much of a move higher for it to capture basically, more momentum on a shorter term versus something like, and if it catches momentum, is moving much, much higher. And XLF is similar. I mean, they're all similar in trend, honestly. Like they all look very, very similar because of the huge drop off that happened on June 8th. It's almost like these prices have to get reset here. And until they get reset, it's likely we're going to kind of trade it in a sideways band, as you just echoed.
Yeah, sideways. Yeah, I personally wouldn't see myself shorting XLF here.
Agreed.
I would definitely short 10 years. So you want a forward looking part here. XLF, TLT and TY. Meaning, I usually use the futures. I don't use TLT. I don't like TLT as an instrument to short. So I use the 10-year U.S. Treasury notes, and they're trading right now at 113. I'd be shorting them between 115 to 116. I've been shorting them pretty successfully since January. I would say I've always held the stance that 10-year note is going to have a disastrous time going through what we're going through. I've never taken a long TLT stance ever. I'll continue to short it, but at this moment, given that being the case for the 10-year note, that does have a little bit of correlation with how XLF behaves in relation to that. But granted that the momentum on XLF is heading down, as you said, I would personally not short XLF here. I would definitely short 10-year at a further $1, $2 bonds from here with a $1 stop loss. So I would be shorting at 115. These are TLT corresponding terms. I'd be shorting at 115 with a 116.43 stop loss on TLT.
And I'm not saying to short XLF here. I wouldn't be. There's a reason why, Coach hasn't hit the button on any kind of general sector or indices. The setup's not there yet, right? So,
Exactly.
what all I'm saying is that the top end of the risk range on XLY would make is much closer to being a 1 month high versus XLF at call it a hair under 34. That's not even close to a 1 month high. As right,
Exactly.
right. So that's all I'm saying from a signal standpoint. Is just if you're looking for a short, just be conscientious as to where the probable ranges or the possible ranges can be and where the top end is versus where it's come from. That's all I wanted to point out.
Yeah,
Trent.
yeah. And just
Yeah.
from that, the corollary, remember a few weeks ago, I derived a corollary that um, that insurance stocks would take a beating. We did see that, AIG went down 20% from there. And I know
Yep.
that I had a similar kind of discussion or debate with someone who was saying, no, they saw that insurance would keep going higher and higher. But we did have a massive 20% correction from those levels. I wasn't short AIG, but I was short Chubb and few others. So from standpoint of insurance, they still look weaker. So when your setup turns right for XLF, I think that setup would also turn to an interesting degree for some of these insurance companies, especially on the PNC side.
Yeah, and Gavin, I'm sorry, I was looking at my screen, but it looked like I think you had your hand raised, buddy. So
No,
I'll
it's
go
all
to you.
good. What's up, guys?
How you
I'm
doing,
not
man?
gonna.
Good evening.
Yeah, good evening. Yeah, no, I was just gonna say the biggest takeaway this weekend for me was the shift where there was literally nothing to be long going in this week
Yeah, I know, right?
for U.S. equities, and now it's basically as simple as like China versus the rest of the world. I mean,
Completely.
and so I guess I would just really throw it out there to people. It's China, right? And so some people are gonna, especially if they're newer, they're gonna question it and say like, oh, I'm not gonna get long China. I'm not gonna try to do that. It's China, and I would just say, given the experience of tracking all this for years, it's like when there's a phase transition, it's like as big as the one that's happening in China, it's worth taking a shot to see if
Mm-hmm.
you could do something, especially when you see it diverging from the rest of the G20, like in a really big way. It's like that could be one of the only things going on this year. So it is China. So I'm not saying like get crazy and like take a huge position, but think about it. Think long and hard about it. What's right for you? I'm about half sized of what I'm going to do. And I'm not even going to say what I'm going to fully do. Just that's up to you guys. But like we're in there and I'll let it kind of like prove itself. It's only been a couple weeks and we'll fill it out and we'll see what we get. But
Yeah, that
um,
was definitely one of the things that jumped out to me this evening, Gavin, was the fact that China remains one of the strongest signals out there on a on a macro basis, certainly on a trade standpoint, right? So there's still time there's still time, and the reason why I mentioned trade is because there's still time in this phase of transition, and it's a very volatile like underlying asset. So again, it's a very good point in terms of being conscientious as to where that low end of the risk range is. If you're thinking you're missing it, take smaller stabs at the stake or whatever at the position, and be conscientious about that, right? But like these phase transitions do look good. And then the other thing I wanted to point out today too was on the underlying side. If you kind of peel China back a little bit, CHIM, CHIX, which is their financials, and then the real estate CHIR, all to me look pretty interesting and on that cusp of sort of making the an even kind of having an even better signal and moving not only from a trade but also kind of a trend perspective. CHIQ and CHIS are also in there as well from a positive kind of signal standpoint, and honestly look better than even most of the larger
Right,
assets
I agree.
that we know, like the K webs and stuff like that.
Yeah, I agree with CHIQ. It's pretty strong on some of the models I've for my own picking as well. And I wanted to add to that, Pinduoduo is having an interesting signal strength as well. And ASHS, so that's the extract or harvest CSI 500. So to add to the list which Rob was giving, the top three in my list for China, I would say forward looking, right? Pinduoduo, um, ASHS, and CHIQ from Rob's list. They're definitely looking really good on long side with appropriate stop losses, of course.
Yeah, and per usual, I'll mention that this is not investment advice. This is educational purposes only. And yeah, we'll be back. Yeah, okay, we can get back to it now. All right.
Yeah, but no, let's be honest. It's China, right? So as
Well, that's
everyone's
the
mentioned,
thing.
I
Yeah.
mean, there's a ton of headline risk. So look, we could be ripping into the summer. Let's say this goes well and we're up 20%. It's August, and then boom, you get smacked by a headline or something. Like, so just keep it in check. Like, it's not like throttle down bullish trend on the S&P 500 where you can do whatever you want. It's China. So, but it's in this environment when it's like the weekend work shows there's nothing to be long in the United States in equities. It's like, well, maybe I'll take a shot because I got a lot of cash and it's something to do. And, it looks like they have a decent roadmap. For me, everything else is pretty much the same. Fixed income, waiting to see, short junk. To me, like all the markets right now look like they need to set back up.
Yeah.
And like big moves just happened, and you see everyone kind of like twiddling their thumbs, like wanting to do something, but they're not getting a price, and they're like, "What should I be doing?" It's like, well, you should probably be waiting for things to set back up because your monkey brain just saw everything go down 18% in the last 3 months, and you want to do something because you're really excited about that momentum, but you have to let it set back up. That's kind of where I think we're at. So we'll see.
Yeah, and if you just again and kind of let that volatility kind of guide you, right? And like look at the OVX, the GBZ, the Move, the VIX, the Vixen, and the Russell Vol, RVX. They all, certainly the Vixen and the RVX kind of look very similar right now, and need to reset either to the upside or the downside. That 34 level is kind of what I'm watching on those two, and then obviously VIX kind of sub 30 is obviously a good thing too. So the oil vol was not a surprise, but sort of definitely had me interested with the move down. It certainly, I think it closed in the held trend, but I think as we've opened back up this evening, it's moved lower on the oil. So that's obviously, looks like it's going to be breaking the trend line, which obviously is not good. And but certainly that oil vol is not sort of spiking and making me really ponder. But most of the CRB commodity index, as Coach has highlighted over the last couple weeks, but certainly in the last few days, I mean, they're all breaking down, right? So this is the disinflationary kind of piece of the game, and you're chasing commodities here. Again, to Gavin's point, it's just not really, other than for a trade, I don't really think it's worth your time or energy to be kind of fretting in that space right now.
Yeah. What do you guys see in, not a big deal, but I do think we could be in an environment for like the next year where like, just a commodity out of the blue is just running, and it's like, well, I don't know, supply and demand, it's commodities. And the one that's been jumping out the last couple of weeks, that's it.
One.
Yeah.
Yeah, man.
What's going on with that?
Coffee's been gangbusters.
I have a ton of coffee in my kitchen.
I drank coffee an hour ago to get prep for this call, Gavin. So there you go. Maybe I think that's I'm firing all cylinders, baby. But yeah, Joe,
there was a famine in Brazil that affected about 20% of their production. That was one of the primary drivers. It's just fundamentally speaking, but obviously you can detect that in the price trend earlier before you get to know the actual reasons.
Now I know when I'm making my coffee tomorrow, Trent. I don't know. There's not much else I'm going to comment on tonight. The only other thing that is interesting is, and this is the only bearish trend that I bought all year, I promise, but it's IVOL. And so
I saw that tweet out of you this morning.
Yeah, and I bought it, and I'll probably end up regretting it because I bought it trying to be smart about something. So we'll see about it. But I mean,
did my chat with Nancy Davis yesterday morning influence you? No.
Well, it's like hearing her talk about it and just how the twos tens needs to widen, and I'm looking at it like, well, I got a signal on it like, a week or so ago, and started a position, and it's like, well, I mean, I'm buying. I think on the day I bought it, like the curve, the twos tens was like pretty flat. It might have been a few bases. I think it was single digits, and I'm just looking at it like, well, it's got a pretty good chance to widen from here, I would think.
Mm-hmm. Mm-hmm.
And I know we always viewed it as a steepener, and I do understand it to be true that if the 2-year, right, was to come down aggressively, that would be the best case for her, right? But I think I have that right. But
that's correct. Yes.
I mean, that would be the ideal case. But if it widens, it's also, she's got some optionality that would take advantage of it. So anyway, fixed income for me is like short junk, long some eyeball. We'll see if it can kind of make a turn, and then PFIX.
I was going to say, you got some of that too? Yeah, that one's been.
Yeah.
It signaled a little bit of weakness about 2 or so weeks ago, and then it's absolutely rebounded really nicely. It's done exactly what it's supposed to do.
Yeah.
Yeah.
And I've been thinking, it's Brian, right, on here, the Muni guy. I've been thinking about Muni bonds a little bit because of what he was saying the other week, and not really like in the macro portfolio, but just in general. It's pretty interesting time for that market. So that's pretty much it for fixed income for me.
Yeah, not the key ones in my humble opinion, like MUB or BAB, really look all that interesting from getting a long standpoint. But you could, if it could shift in a week or so, but need some help. But Brian did share. He's actually coming on, so why don't we go to him? And then he did share, which I retweeted, some of his kind of the current positionings on the rates and stuff like that. So he shared that earlier today, which I retweeted. So I can try to pin that. Brian, why don't I pass you the puck, and then I'll pin that to the nest here.
Okay, cool. I'll make it short. I actually sent a message to Robert earlier. I wasn't planning on speaking, but I heard Gavin, so I just jumped off the treadmill. It's not really a whole lot to share in the muni space, except for today we got this rally. So kind of started in the morning with the early print and ended up with about a 3 basis point rally. I changed the table that I've been sharing and kind of starting to take it from notebook session to notebook session, so people can kind of look at it on a weekly basis and I think better appreciate maybe the move. So last week I talked about a transaction that I've got coming up that we had headwinds, and I was told that they can't give you a scale, and just a pretty poor municipal market to sell into. And then now all of a sudden, right, I was actually trying to figure out what was going on today, and I pulled up something and said, PE used to be PE Pal was speaking, and he used the R word, and I'm like, that's why we're rallying. So we saw a little firmness. There's some bonds selling tomorrow for my personal consumption in Kentucky. Pretty good name. In 20 years, the early bid that one firm that buys a lot was putting out in 20 years was a 4% coupon to yield of 4.20. And so I offered to give a pre-market order at 4.25 at par, and I was told that they had no problem selling those bonds and they weren't interested. So it seems like to me that in the high grade muni space, we're sort of having a pivot back to fear. Rates look attractive. My taxable equivalent yield on high quality looks attractive. And then I also put a piece out, I think it might have been over the weekend. I was getting a lot of questions about credit ratings, and I think people were looking for me to say, A rated or better is great, or a triple B is better, or just, where am I at individually in terms of credit ratings? And I wanted to share that school bonds in particular in a lot of states have an additional enhancement called a state intercept program. And Fidelity did a nice write-up here in 22, actually, of every state that has a state intercept program and its strengths and its weaknesses. But that's an additional reason why I talk a lot about my personal preferences in school bonds and utilities. Anything that has a toll road, it says toll road or turnpike. I'm running away from healthcare. I don't buy healthcare. Small colleges. I've actually had a small college in my career go bankrupt, so I don't buy small colleges. We had one here in Kentucky that I did not work with that also went bankrupt. So we've seen that before, but we haven't seen K through 12 bankrupt. We haven't seen utilities really bankrupt. So safe, solid with a decent return. The other thing that I wanted to share that I consider a mistake on my part is sort of the transitioning from leveraged funds to individual bonds or non-leveraged funds. So I received some questions on what do you think of this fund or that fund, and the first thing I went and looked for was leverage. And you have to understand that what leverage is in a fund is they sell short-term warrants that are on SIFMA. It's a weekly rate. And so it should move up with the Fed. And so as the yield curve flattens, the ability to leverage that fund or leverage that rate diminishes. And you should see some pressure on the NAV. I was a little late in my rotation out of leveraged funds as the Fed started increasing rates. I know, Trend, I was telling you they're going to go 75, and you were asking me why, and I said it was because I had listened to his first speech that DeMartino Booth talked about, and he was just totally different in his demeanor. But I didn't put two and two together that, Brian, you need to rotate out of the leveraged and into individual bonds. So that was a mistake on my part. And then I guess the last thing I want to say, this is kind of a tag on to what Gavin said. The macro show, not yesterday, but I'm sorry, not today, but I think it was yesterday's macro show. It was the first time I heard Coach kind of talk about being in cash was okay. That, Quad 4, it really feels like when I'm looking at the Macro Pro ETFs, they're diminishing. There's fewer and fewer of them. And it just seems like there's nothing to own. I got to Friday, like Gavin said, and I'm just looking at everything and saying, every single thing on my screen except dollars in UGA gasoline is bearish. And it feels like we're at this point in time where we're kind of ready for this next turn to happen. And it may be that, things that are supposed to work in Quad 4. And I was actually looking at it today, sort of the roadmap of Quad 4, best asset classes to own in Quad 4 deflation that HYG puts out. None of them are Quad 4 bullish right now. So maybe it's just time to continue to be patient. And so that's kind of what I'm doing. And I'm just looking for spots in municipal bonds here and there, and really just kind of waiting. So a little bit of a rally this week, a little bit of a little more firmer footing in the muni market. Retail buyers seem to like this 4% higher level. So my tone this week is a little bit more strength, less cracks, and deals should be getting done that are higher grade. So I'll leave it at that unless there's any questions for me.
Thank you. It's awesome to get that update, Brian. Thank you very much.
No problem.
Yeah, other side. Do you have a question for him?
No. It was great stuff. I just tagging on. But
can you just give me 1 second then? Mike has to come up. Hey, Mike, welcome. Did you have a question for?
Yeah,
for
thanks,
Brian?
Robert. Hey, Brian.
Yeah, of course. Buddy.
I was listening to Steph Pomboy the other day on Wealthion, and she was one of her comments towards the end of the show was she was talking about avoiding munis at this point because her logic, is, if I understood it correctly, was in a severe bear market, a big downdraft, some of these pensions that are in either these school districts or probably not utilities anymore, but certainly the school districts still have defined benefit plans, at least the ones where I'm at do. And they potentially have a serious funding issue that may detract from the quality or drive some type of hit on the muni. Do you have any thoughts on that? And if there's a way to do research when you're looking at an individual muni to figure out whether or not that's a risk, or if that's, like with a utility, you could check to see if they even have a defined benefit plan versus a defined contribution plan or something like that. But any thoughts on that?
Yeah, I have two thoughts on that. I actually have a call tomorrow, a ratings call, so pulling up the notes to see if I put anything in it. So my first comment on that is every state is going to be different in terms of defined contributions to these plans. And so part of the bond rating process by mostly Moody's and Standard & Poor's, there will be a discussion and a hard look at what sort of pressures they can absorb or they may feel in the general fund. So it's the first thing I would say is read the rating report that accompanies any bond that you purchase, and it should have a paragraph or two paragraphs on that potential risk. The second thing that just popped in my mind, I just typed it in real quick and pulled it up here on the internet. And I'll just read it verbatim. It says, as many investors recall, Meredith Whitney said in December of 2010 broadcast of 60 Minutes, there would be 50 to 100 sizable defaults in the municipal market during the upcoming year. The defaults would total hundreds of billions of dollars, she said. And we all know that she was completely wrong. So I think my answer to you is, it is a risk, and it's one that is reviewed by the rating agencies, and it's a credit by credit analysis. And is Keith still on? Let me see here. Is Keith still on? Someone I work for was on here, and he likes to jump into this topic. I think he might have dropped, but did that answer your question?
Yeah, it did. Thank you very much. That's really helpful.
Okay.
Awesome. Well, if there aren't any other questions, Brian, always a pleasure. Thanks for jumping up, bud. Your insight's very valuable, so thank you very much for sharing and taking the time to do so. Other side, floor is yours, my man.
I jumped on a little bit later, so I missed a few things, but it sounds like whole waiting and watching is the common theme. We really haven't done much of anything. I didn't pull off any trades today. Nice to see that I own some of the things you guys like, and the more I'm listening, and the more I've been writing my monthly, and I was just, this one's kind of stuck in my head as we're talking about mortgage rates skyrocketing. And Keith has mentioned the only thing the 75 basis point raise does is increase the cost of capital, right? I just want everybody to think about how that affects all capital markets and all bond markets. So I think there's I could be wrong on this number. I think I'm pretty damn close, but I think there's nearly $1 trillion globally that needs to reprice bond-wise between now and the end of the year. And all of that money needs to reprice at nearly double the rates that these companies were paying on bonds recently, right? So that's all going to come down to hit margins. And in that hitting margins, that's going to trickle into layoffs as well. So it, as Coach typically says, time and space. These companies are not refinancing or or they're hoping to refinance, maybe if the Fed comes in and tries to bail people out, so rates start to go down again, so their refinancing costs aren't as great. But as the end of the year comes and they're running out of time, they're gonna have to do these refinancing or refunding corporate issues, and that's really going to start to hurt. So the longer we get into this, it kind of goes into Mike T's thought of Q3 a little bit later. It's just definitely something to think about, because mortgage rates now from say 3% to 603, 50% increase in say just a $400,000 mortgage. If you're not putting anything down, just simple math, you're literally 49 and change percent increase over what you were paying. So these corporations are literally going to be paying 50% more on their bond issues. So are governments, right? So are municipalities, hospitals, you name it, federal government as well. But those guys will just tax the shit out of you, right? Corporations that are losing money because the consumer is weakening, they don't have the ability to do that. So they need to cut fat, and that's layoffs. That swath hasn't come yet. So just be mindful of that.
Yeah, but there's so many different ways. Again, the cost of capital is absolutely increasing, but I don't think they're going to, again, it depends on who you are, what they're doing, et cetera, in terms of just being completely cut off, and whether or not they're willing to make adjustments in terms of how that goes, right? Whether it's a callable note or a convert, or just even raising equity. Again, I'm not saying that's a good thing to do, or that the stock's not going to get punished for that, but there's definitely ways of getting capital, right?
I'm not saying
So yeah, I'm with you there in terms of cost of capital. Absolutely is something to monitor, and Trends mentioned this over the last couple of months in terms of looking at some of the underlying components inside of JNK or HYG, and go hunt for some of the weakest, especially Trend. If memory serves, you specifically were talking about some energy names, and some maybe retail, was it, buddy? I can't remember. Definitely energy, if
this
from what
is
I remember. But
this is
yeah, but
this is less company specific as of right now, and more so how these things will adversely affect equity prices, layoffs, and bond prices as we move forward over the next handful of months. Again, just something conceptually to think about. This is more of a time and space thing, and it is going to adversely affect a lot of these companies from the standpoint of layoffs, margin squeezes, earnings recession, etc. So just
yeah, but you're already seeing that in the move and stuff, right? You're seeing that in the move. You're looking at, like, again, even investment grade LQD. It's been an absolute disaster. It's across the board, right? The move at move at basically north of one, or around 130. That's just it's uninvestable, right? So it's
move
yeah.
is move is treasuries. This is more
I know.
corporate.
I'm just saying. I understand. I'm talking. Yeah, correct. I'm using that as a proxy for, like, treasuries and fixed income, right? But you're seeing it across the board. Yeah, I'm with you. I think.
I just think the more I think about it, the more no one's ready for what's going to come from a credit standpoint. I think people are ill prepared for what's going to come from a credit standpoint. Just my opinion.
Got it. That's fair.
In what spaces?
Yeah, I just think. Yeah.
Like, I think that's the key, is what spaces.
Well, you could start by anything retail, right? Consumer slowing in the retail sector the most. Howard Penny.
I know, but
What's that?
I don't know. I think we need to come back maybe next week with a bit more, like, data and numbers and signal. And, like, I don't want to just kind of just randomly pick sectors or what have you.
That's fine.
Yeah.
You just asked a question, but yeah.
I know. Again, you got to do your own due diligence, right, Brian? But start with JNK or HYG. It's a great place to go. It's the reason why it's called junk, right? So go look there, and then dwindle it down to folks that either don't have cash flow or have very limited. I don't know, Trend. You literally just did this, like, you keep doing this every week. So why don't you maybe review kind of how you look at it, or what you
Yeah, I can. I think I can
just briefly, right? Like high level, Trend, high level.
Yeah, sure.
Yeah.
So I can share the methodology I use, in addition to the JNK piece, which you mentioned, by undergoing, cracking that holdings open of at ETF. What you'll find in JNK is there's Netflix, there's a few highly levered companies, and their spreads have definitely widened. So the other thing that I do is I try to find out uh, whose refinancing is coming up, right? And that's where we'll start actually seeing the cracks. That are they able to issue debt at a price that is affordable to them? And if you want much more liquid names instead of those which are in junk, meaning the equity of the folks who are in junk, you could definitely just stick to the Russell 2000, right? And you can do a simple rank ordering of the companies where the free cash flow is, or even the operating cash flow, right? The operating cash flow is unable to meet unable to do the interest coverage. There's a specific ratio when your interest coverage ratio um, is unable to meet a certain threshold. Those become your best places to just create a basket of 10 to 20 names and then just short them against a long on IWM, so you get a relative. You get basically, you can extract alpha out of that. So once again, the steps are: you take your Russell 2000, you take the ratio of all of those on the interest coverage ratio side. You take the worst decile, right? And you don't have to go through all 200, or don't create a basket of all 200, because there were 2000 names. Take the liquid ones, right? That will narrow it down to maybe 20 names. And then you short that against your Russell 2000 broader index long. Now, Russell 2000 is going to go down as well, but these stocks will go way worse down. And that becomes like a nice satellite for you to extracting alpha if you want to do a long short. If you want to go outright short on them, be my guest. I sometimes do an outright short too, but I would have to wait for a good setup for an outright short. So, most likely there's a seasonality element to the period between now and 4th of July, which is a very high probability of some sort of a bounce. Of course, none of those probabilities were calculated with central bank tightening into a slowdown. So even though the high probability exists, we are in a situation where people are reading their statements and people are like panicking and sending the outflows. Now, that's the last part I want to touch upon. This is in addition, this is a separate topic now, that we aren't seeing as many outflows yet. The moment we start seeing those outflows, that's our next leg down, right? And at that time, we might end up getting some interesting generational opportunities where companies are selling at market caps less than the cash they hold. So, yeah, I just wanted to extend that.
Yeah, it's a good point. I mean, it's again, many here on this call, they can't just be in 80% cash, So, finding those places where you are beating the market on a relative basis, being long, is really important. One of those places, year to date certainly has been in higher dividend, paying quality names. VYM obviously is the Vanguard one. It does have a decent amount of energy in it as a top 10 holding. So, obviously, kind of, I think Chevron and ExxonMobil are both in there. So, kind of, you got to take that one with a bit of a grain of salt because it's been, aided by the energy and that kind of thing. But, even SPHD, which is the Invesco one, that's been a relative outperformer as well. Definitely has a bit more kind of consumers and some youths and stuff like that in it. So definitely take a look under the hood there, or do what Trend and I often do, which is build a basket of your own. I kind of tweeted that out earlier. Again, it's not about me. I don't really love talking about kind of what I do, but the basket was of Nike, Valvoline, Deere, and what was the last one? TJ Maxx. And built like a 4% position in that going into the close. Most of those were at the low end of the risk range, and again, it's just kind of paying attention to what analysts are saying on the call, or your own due diligence in house. And there's definitely times and places to try to take advantage of that and get longer for whether it's for your clients or your own portfolio. There's definitely places, again, there's nowhere to really go in terms of general sector ETFs and stuff like that, but there are still some underlying companies that are certainly worthwhile, or at least worth a look at, to Trent's point, right? And if we get another big leg down, that's the place where just make sure you kind of know your top 5, right, or your top 10 that you're like, okay, in 3 years' time, I really want to be long XYZ, and just make sure you know where your spot is, where you want to get along that asset. All right, Arthur, you jumped on, and then why don't we open it up to any questions or any other thoughts from and Palmer, you jumped on too. Did you want to talk mortgage rates or anything like that, or what you're seeing? Sorry, Arthur, just give me 30 seconds, man.
Well, I was going to call out something I saw today, and I didn't realize this had happened, but Logan Matashami, he's a pretty good follow. He's I don't remember if he's can't remember what he does for a living. I don't know if he's a mortgage economist or what he is, but he tweeted out a chart there today that showed interest rates, over, I think, last 30 years. I didn't realize the Fed had sold a bunch of MBS between 1975 and 81, and if you look at the chart, it's stunning, the increase in mortgage rates. So there's a real negative effect to mortgage rates that we're seeing with them removing MBS off their balance sheet. At least with regards on the ground, of course, hell, there's so many different housing markets in this country. I mean, we're still, hell, we had an offer today on a house. I mean, and we're still seeing normal offering right now. So people are still buying. I just don't know, like other side was talking about there. We get into job layoffs and that type of stuff. I don't know what's going to happen then. But right now, I mean, supply is still pretty tight. It seems hard to believe, but it is. So.
Yeah, makes sense. Yeah, good stuff. Appreciate that, Palmer. Arthur, welcome. Hey, welcome. Yeah.
So you guys have really covered what I wanted to comment on relative to, but I wanted to make one other statement or comment. I listen really close, as I know all of us do, to Keith on the macro show, and I think might have been today, maybe yesterday. He says the most important things he says are those little things, almost on the side. You know what I mean? He says HYG, it's the easiest trade I've had all year, kind of thing. Paraphrasing. Do you remember that?
Yeah. That was yesterday morning. Yeah.
Okay, yesterday morning. So, I mean, I've been watching that thing like a hawk, and I'll tell you what, it's been the easiest trade for me. And back to kind of what Other was saying, you can get in the weeds and do what a friend does. That's not me. You got to be who you are, right?
Yeah.
And I've been buying puts in HYG forever. I bought more today. Now they're out in December and January, but I'm up, 250%. And I'm just, every time she gets green. And if you guys noticed, when we had that big up day this week, HYG or Junk didn't participate much at all. I mean, they're like dead. I mean, I don't know if you guys see that, and I know that's not technical risk, management kind of stuff.
No,
I'm just watching them. I'm going, these things are pieces of shit.
Yeah.
And so anyway, I'm going to end with this
last week when it ticked like 75, it was like some of those puts like didn't really budge much. They were like, you had no action on them.
So anyway, I got a little longer China today, and I shorted a little more HYG, and that's all I did. So thanks, you guys.
Yeah. Absolutely. No, thanks for jumping on. And I know Gavin, I think that's been one of his, I think, Gavin, I don't want to speak for you, but I believe, we speak a lot. So I want to say, dollar and short the high yield or the JNK, however you want to go about it. That's been 2 year, I guess, full cycle investing this year to date.
Yeah.
Yeah, for sure. And Arthur, I love how simple you're keeping it, man. It's awesome. I would just say, going back, because we've been short for a while, and I mean, when it is that simple, and it was cruising along, back when we had that, I don't know what it was due to. Maybe Trend probably knows, if it was short covering or whatever. But back in late May, when we had that amazing opportunity to short it really big again. But those were some pretty wild days, So I guess at this point, we can, all kind of expect, well, hey, that something like that could happen again. Mm-hmm. So yeah, but no, I agree. It's been pretty persistent to the downside. So I actually have to get going point, here, right? Guys.
Yeah. Have a good night, Gavin.
All right.
And Arthur, to your point, when that kind of rally happens, I also jump in just, without actually going into the details to buy some puts on JNK. And they were multi-baggers. They ended up being like 7-8 bagger by the next week. It was beyond my imagination. I mean, I expected them to go through just like 3 or 4x and get out. But before I could get out of them, it just collapsed down to 91, 90. And then I was like, okay, I'm getting out of here.
Yeah, but and Gavin, thank you as always. I know he's left, but thank you for always contributing to these sessions. But Arthur, it's a good example though on the HYG where the day-to-day trade, right, on the top end of the risk range is significantly lower than the top end of the trend from ETF Pro, right? So, again, without giving the specific numbers, you're at, 78-ish on the trend, top end of the risk range, and you're at, 76.5 on the on the trade today, right? So again, it's just exactly. So I mean, again, I say that just because we've been sitting on our hands a little bit, right, in terms of being patient and trying to understand where to go, and sometimes you got to just not necessarily have to, but you have that urge to put on a trade, and again, Arthur, I think you absolutely did the right thing, right, in terms of what you saw today. But my only comment is that 74 handle on the HYG can quickly become 78, just from a pure math standpoint, right? So it's just going to the top end of the range, and nothing would really change, right, in terms of the difference in the downward or the negative kind of trend, right? The negative trend that it is over the course of a longer term basis. So again, that's all I'll echo, because it's a perfect example of what I was trying to say earlier on that IWM or XLY, that kind of thing, right? So just kind of being cognizant of, and luckily HYG we get every day, so you can kind of make that cross reference between what it looks like on the ETF Pro versus the daily range.
Yeah, I appreciate that. I'll just end with one word.
Yeah,
blotto.
Yeah, man. I hear you, buddy. I hear you. Good stuff. Yeah. Brian, do you have a commentary or a question?
Yeah, I've got a question for Trend, actually. He's more technical, and I think could give me some color on this. So getting back kind of to the HYG process and staying kind of on within that confines. So quad 4 deflation, when you look through the best asset classes, best equity style, best fixed income. Me and some guys that work with me, we went back through all the old. I don't know if someone's using the bathroom or something here. We kind of went back through the prior quad 4s and just looked at like TLT and how it performed, and we looked at certain equities like Johnson & Johnson or Procter & Gamble, and it just sort of seemed like everything didn't work before these specific asset classes started to work. And I didn't know if you had any sort of insight or study that you have done that might shed some light on, like why a TLT is supposed to work in quad 4, but it's not working right now, but it could be working in 3 months.
Yes, so there are two aspects, right? We are still undergoing a repricing of risk, and when a repricing of risk happens, we do tend to see all these exaggerations. So, for instance, there's an exaggeration of from the standpoint of when is that big Fed put going to come, right? The moment that Fed put is decided and we are still in quad 4 at that point of time, that's when you start seeing some of these things giving you some outperformance. So for instance, healthcare relative to SPY, or meaning XLV relative to SPY, or some of the other names that you mentioned, XLP relative to SPY. And it's a relative trade, keep that in mind, right? So relative asset allocation, you'd want to be overweight some of those names as compared to others. But that happens only when the repricing of risk is complete. Right now, we are going through what is called as a dislocation, and there are specific trend traders, right? They would keep on seeking dislocation as compared to being a convergent trader and trying to converge it back, saying that, oh, I'm going to buy the dip. No large trend traders are uh, you know dislocation resolving, their dislocation seeking. And at this moment, Fed is also not seeking to resolve the dislocation, and that's where you're facing this kind of situation where stuff is not going to work until you hear from the largest money flow that, hey, we're going to step in or we're going to stop this. So from my prior studies, what I found is, I'll give you a simple example, right? And you brought up a good point, because I was going through my previous study on this, which I had done. Number one, even back in 2008, when I was looking at all the details, I found that until the point the Fed did not come back till March 2009, stating, especially March 6, 2009, that was the date, that the Fed put us in, the market kept going down, right? Nothing was working. Even your JNJ, XLP, nothing was working. None of those components were working. Even though we were in severe quad 4 at that point of time, right? Really deep quad 4. Same with back in 2001, 2002. So all those studies just gave me one idea, that the place where those quad 4 asset allocations, which you described, right, from that sheet work, are after you've been told that the Fed put is in, or after there's some sort of indication that we're close to the Fed put being in. But right now, there's no Fed put, so there's a massive repricing of risk, and all the dislocation-seeking actors are going in that direction, that the dislocation will keep widening until the time the Fed will reverse. And Keith also talks about it, right? So Keith sometimes talks about saying that they're doing the wrong thing right now, and they'll be forced to reverse this stance, or they'll be forced to go dovish. So this 9 or 10 rate hikes, which we're saying by the end of the year, it's not gonna happen. After maybe 6, they'll just stop. So does that help?
Yeah, it does. I mean, from my perspective, this is my first quad 4 that I have actively tried to risk manage, and it's my I only started with HYG right after Thanksgiving, so I have not been. I'm still learning this process, and so it's hard for me to kind of understand why XLU is bearish trend, right? And then why every single thing on my screen is bearish trend. Like all of a sudden,
right?
Everything that you've been kind of conditioned to think should work and should be safe, it's just like nothing is. And I took those notes from the Mike Taylor, the bottom, and I keep staring at number 4, July, August, massive Q2 earnings revisions down. And I look at the bottom right of my, my screen, and it says June 22nd. I'm like, oh, well, that's not July, August. So I just feel like it kind of helps to validate that we're in this process. And
Brian, I mean, just to simplify,
patient.
this is kind of almost simplified from an equity standpoint. Certainly on the U.S. equity side. If you go back to April 22nd, so 2 months ago, VIX basically closed north of 24, and it's been there north of 24 ever since, right? So for the last 2 months, volatility has been elevated, not only within the chop bucket, but on the top end of the chop bucket. So that to me is a key component as to why things like XLU, XLRE, traditional kind of U.S. equity exposures that typically work aren't working. And then conversely, with the move where you were talking about kind of TLT and stuff like that, that's been basically north of 100, all going all the way back to March 22nd. So that's almost 3 months now, right? So again, sorry, it's dipped down to like 97 or whatever, but call it north of 95 for almost 3 months, right, Brian? So that's not good. The volatility regimes are not good, and that's where money typically seeks lower volatility regimes, right? So it's attracted to that. So that's where oil OVX has worked. GVZ until kind of recently, had been in that kind of general range, right? Kind of north of, sort of sub 20. Those are volatility. OVX is a good example too, right? Where it's been, sub 55 for almost, for over 2 months, or certainly sub 56 for almost 2 months, and that kind of thing. So that's where, if you just think about where does capital flow, it flows to areas where lower volatility exists, especially when volatility is high in other, traditional asset classes. But it's a good call out on the GNG. I mean, it's one of the reasons why XLV is looking more attractive. So again, that would tell me, okay, maybe keep an eye on pink. The 10-day price momentum, I'd be watching that across all the things that kind of caught a 1 week momentum. So that'd be XLV, XLRE, XLP, XLU, and some of those underlying components like Coca-Cola, for instance, or even Pepsi, but Coke in particular. that looks pretty interesting inside of XLP. Monster Energy is a great example of something that's been bullish. It's currently, I believe, bullish trade trend. That's been a great place to park your money. I have not owned Monster Energy, but I am kicking myself that I haven't. But that's been a great example of something where you could be long it, and it could be paying you. Again, I don't know if it actually pays dividends, but it could be paying you, dividends in terms of a relative outperformance. Absolutely.
Thank you for that.
Yeah. All right, we'll open up to any other questions that we might have, and then maybe we'll just kind of, if we don't have many, we'll sort of shut down.
I wanted to add, Rob, to
Trent, go ahead.
Previous point. So to build upon that, right, Brian, what that study also indicated to me, when I actually opened up back my spreadsheet again, and what I found was that if you look at purely relative trade, right? So for instance, let's say you were long XLV and short SPY. Even year to date, you got a 8% alpha, or almost 8% alpha. So I think that asset allocation chart that you see in general, it's more in a relative fashion, right? That's why it talks about overweight and underweight, because it's kind of giving PMs who are trying to do long short some sense that, okay, where can you try to search your longs versus where can you try to search your shorts. So for instance, if a PM is trying to make a 120% long short book, they would be constructing it in that fashion, especially for quad 4, where they would go for, and keep in mind, right now the market is trading with the signal which front runs the actual quad, with a quad 4, because I know that many people have raised this question that, hey, we are actually in quad 3, but the signal is purely for quad 4, because the entire ecosystem right now is pretty clear that we are about to head in a slowdown. I heard earlier Mitch was saying about the layoffs, etc., or we are going to face some kind of a slowdown eventually. But if that is the forward-looking part of the market, until the market sniffs out that, hey, it's going to change because of whatever reason, right? Fed decides to go dovish, something else happens, we start seeing PMI numbers below 50, both in US and abroad, then that's the point where you might start seeing a switch. But to give you the exact relative positioning, even if you look at XLV relative to SPY today, it's giving you a positive 8% alpha. Back to you, Rob.
Yeah, I just wanted. Did that make sense, Brian? I know Trent kind of covered a lot of detail on that.
Yeah, no, it does. I mean, it does. I mean, and I think when you go back and you look at prior Claude fours, it kind of helps you kind of create the visual. But I was actually just pulling up the last email I got on Macro Pro ETFs, and this one has 6, and I think he cut 2 today. So I would imagine if I get an update tomorrow, there's only going to be 4 macro ETF positions. So I mean, I'm not trying to be a Debbie Downer, but I mean, Jesus, it's just getting to be pretty easy to to own things when there's only 4 things on the page. So.
Well, that's it. No, I mean, completely, man. And it's kind of goes back to what, again, we can kind of reset the room a little bit, right? And maybe take some one-off sort of trades or components as to what something maybe has jumped off something where you were potentially interested in doing, but didn't pull the trigger, or did pull the trigger and it went sideways on you. I think again, I'm not really calling Keith out. It's just I think many of us got long PXE, and then obviously energy just absolutely tanked, right? So if you didn't have a stop loss in there or manage that tightly, then you were down. You're down quickly, right? So anyway, long story short, what my point is that it's got to be personal, right, Brian? It's personal as to he's not long a whole lot. He's telling you that cash is king. Is that where you want to be? That's up to you. It's almost up to you to decide, right, man? It's
you'd actually be Brian has a mind-blowing asset allocation right now. He shared with me his numbers. It was 80% cash.
It is.
Munis.
I don't trust anybody right now.
Yeah, no, and
He
again,
outperformed 99% asset managers.
But that's the thing, right? So, Brian, that's the thing. It's one of the things too to consider. Again, it's different for everybody, because there's folks on here that are listening in that are everything from an investor for their own personal capital, to managing money for others, to managing funds or what have you, right? So it's quite a broad scope. So if if you can just sit in cash, right, then and you're looking for those kind of outsized returns or kind of that capital flow to go compound, right, when the time is right, then almost just have patience, right? Have some of those longer full cycle kind of short ideas, right? So whether it's Russell or NASDAQ or high yield growth or junk, whatever it might be, right? That's been working, that appears that's going to keep working, then have those on, right, in a smaller portion of the portfolio, and then sort of sit on that cash and just be ready to execute when it seems like we're really coming out the other side. Which again, but you just have to be comfortable with the fact that could be 3 quarters from now, and you might miss. And again, it's not that you might miss the bottom. You're going to miss the bottom, but it's just you just have to be comfortable with that and understand sort of that's going to be my quote unquote new investing strategy. But that doesn't mean that everybody has to do it that way, or that they can, because some folks have to be long, right? They have to have exposure to the market. And there are signals out there that are getting slightly better, or at least that are tweaking a little bit if you're kind of looking in the right spots.
No, and I appreciate that. I think one of the things from my process that I've done, and I did share with Dred the current allocations, is to build with individual bonds enough passive income that I am comfortable that there is some incoming alpha, right?
Mm-hmm.
And then as a alternative to UPP, because just because of some volatility and the idea that, that it's up so much this year, I did buy some 3-month CDs just because they were, with the Fed increase, they're at 2%. So small position, but normally I just kind of diversified my UPP thesis for myself. Sure. But I am sitting on cash. But I do own 2 equity positions, just in full disclosure. One is Disney, just as a family favorite, but the other one is Playboy. I'm still long my Playboy, and I will not sell my Playboy. Yeah, so with that, hey, thanks guys. I got to jump off here, but have a good.
I had to say it, bro. Both Disney and Playboy don't look great, but yeah, yeah. Let's. All right, so let's maybe reset the room. Trend, do you want to go through, something that maybe you saw, or kind of, how do I want us to do this?
Sure. So
Like just sort of
on the
something that's
China
sort of
theme,
like maybe just interesting, right? Or like that
yes, yes,
the
yes.
setup is moving in the right direction. It's not a buy now moment, right? But it's more like if this continues to kind of move in the right way, then this is something that's going to move up my list, right? I think
Yes, yes.
that's kind of, if that's what, does that make sense in terms of what I'm
Yeah,
trying to
it
say?
does.
So like kind of like what's moving up the list, right? In terms of
Yes,
we've been very clear that pretty much everything sucks. So what's moving up the list?
sure. So Pinduoduo is moving up the list on the China front. And if someone doesn't want, I mean, if people don't like uh, eccentric risk, idiosyncratic risk associated with just one company, then I think I shared the other one, which was ASHS. And uh, KWeb, I haven't pulled the trigger yet, but I'll be pulling the trigger as soon as the weekly momentum gets slightly better. But definitely on the daily momentum, it's on my, it's getting better. Very hard stop at around for KWeb at 29.56, and for Pinduoduo hard stop at about it's much deeper for Pinduoduo. It's at around 51.21. That's almost like 16% below from here. So, um, but Pinduoduo definitely on my list, and KWeb. Those are two which are moving up the list. I've taken a very short term ISRG long as well. Um, but that's just for purely short term momentum, nothing to do with the full trade trend tail, because it's not giving the right signal uh, for the tail.
Yeah, that makes sense. Yeah, China's definitely moving up the list. I'd say some of these dividend ones are like, again, like the JNJ. I actually just pulled it up, so this one's kind of new. I'm going to put this one in my notebook. So just full disclosure, you're getting this real time, boys and girls. JNJ is going down, and I'm circling it. It had a good move today. I got to check on the volume and stuff like that. But that one, I had highlighted the XLV, and obviously, Johnson and Johnson is a big component inside of the XLV. So J&J would be one. Coke was another I just pulled up too. It's kind of like a DV player. Again, I'm not long this one either, but it's kind of, you can kind of recapture some trend here. Again, obviously, inflation margins, that can be an issue. But I'm kind of leaning a bit more towards some of these underlying components. And again, I think trend, if you can't tell, given the fact that I was building a basket of stuff that was at the, almost pushing, 1 month lows and 3 month lows like Nike and stuff like that. But Valvoline is obviously very interesting too. But I'm getting more interested in some of these underlying pieces versus the ETFs themselves, and sort of trying to pick out some underlying winners, or ones that are certainly at least gaining a bit more momentum, and leaving some of the sector ETFs alone for right now. Yeah, Palmer, go ahead.
Yeah, one of the things I was kind of messing around, and stuck at home today with the sick kids, so I didn't have much ability to get any work done for work, so I was on my phone all day listening to stuff, and I kind of fell into a uranium warp hole, and I don't know. I've been thinking a lot about energy. It's definitely a secular trend right now, and one of the things I come across today, I didn't know this, but I guess there's 43, 42 nuclear plants that'll open globally in the next year, and then there's 100 and some odd plants in the pipeline to be built or approved, and so I started kind of looking at URA today, and I own URA. I've hung on to it since Keith had it on RTA there, and it kind of shit the bed. I went ahead and stuck with it, and have been actively trading it. I didn't know about NLR because it's kind of an interesting mix of some of the stronger uranium miners, and then some of the nuclear energy producers. And
that one looks okay. So it's Linamar.
Yeah, and NLR.
Yeah, that one looks all right. URA looks like hell. URA does not look good. LNR does look pretty good, or signals definitely better on LNR. The one also is moving up the list. Trend. Have you noticed some gold miners have started to kind of act a little bit better?
So like which ones specifically?
Well, some of the big boys, like again, they're all
Nova Gold.
Like Nova Gold, Franco Nevada, even Barrick, right? Like gold. I just think GDX in general, in terms of like if you gotta put my feet into a fire to own a sector ETF, that'd probably be on the short list in terms of kind of phase transition, longer full cycle investing opportunity here. But again, it's bearish traded trend, so it's like why mess with it until the signal improves.
Yeah, no, I wouldn't go close to NG or gold or JNK.
I was kind of surprised that Keith has kept GDX on, for so long. It just seemed unlike him. I get the whole, I know the whole background on Playboy, but I've been a little bit shocked he's hung on to that. I'm actually, I own a pretty good chunk of GDXD. I bought it, I think it was yesterday or day before yesterday, and it was up. That's a 3x inverse on gold miners.
So I think here's the deal on GDX. Usually what happens is where dollar is at the moment, there's a tendency, at least in the past, for dollar to kind of mean revert. When that happens, it would put an upward pressure on the gold and silver ones. So I think he might be
a huge input cost for all these miners is oil, though, right? So and diesel, et cetera. So I mean, that staying and remaining high has been a huge drag across the board. So again, you are correct as well. Trend. Sorry, I didn't.
No, I was saying that basically he's just keeping it for mean reversion, and then when the mean reversion happens, he can probably reduce his loss, or maybe even exit it at some minor gain or something. So that way, track record wise, it shows a decent track record, but you do have a drawdown.
And then and again, I think if you kind of I don't know what the correlation is with oil, but I would suspect it's pretty high. And so if you've got oil, losing signal strength, then it's possible that margins are going to start to improve within some of these gold miners, and that could be benefit from that perspective as well.
That was actually one of the things that I saw on Twitter. One of the bigger uranium feeds was, made a comment that you'd think with oil going in the other direction that uranium might not be. It was just basically following suit because it was energy, but that doesn't make any sense because if oil gets cheaper, your input costs get cheaper to mine. So,
it makes sense. Pokey, welcome.
Hey guys, great to be here. Great conversation as always. Hey Robert, I had a question for you. I'm seeing similar things, right? I'm seeing some green shoots within individual stocks. When you're looking at this, when you're talking about this, is your time horizon kind of like the next, I'd say, like 8 or 9 days, knowing that we have inflows and then probably what's going to be a pretty good markup in the quarter end?
Yeah, I'd say kind of to trend commented like July 4th, I think. Definitely. I got end of month basically, and we can transition that to a bit more of kind of setup going into quarter end, month end. But I would agree, Poke. That's definitely. If I get long as a signal, I'm still waiting on a little bit of confirmation, but to get, the VVIX definitely trended in the right direction. Sub, what was it? Sorry, sub 100. Right, I think closed around 99 or 98, and so that was sort of one signal. But there's got to be a number of others that really got to tick, and one of the big ones is obviously volume. So volume was kind of there today, and depending on what you looked at, but not really. Not enough to really get me going, to really get big conviction. Hence why I sort of went and tried to pick out some underlying assets, Poke. But yes, definitely a bit more shorter term trade, and then with the anticipation that those Q2 earnings are going to be quite vicious. But again, I say that, and that's where I think paying attention to the call, or sort of where those. Again, just to use the HYG vernacular, like where the pot acceleration could come from, for instance, I'm not trying to pitch my book because it's not, but I did choose my 4 inside of my basket for more than just sort of low end of the risk range, right? It's like, okay, Valvoline, It's got this spin out optionality, right? And it's kind of given all of that back in terms of the pop from that announcement. It does thrive from, or it definitely does better when, folks are either, managing their own kind of issues on the car and that kind of stuff, right? So, there's definitely components there, right, where their earnings might not be quite as bad as something else, right? Because getting to work is, again, I mean, I'm kind of getting into narratives here, but my point is that, you're listening in to some of these conversations on the call, and again, I don't have, pro subs to all the analysts, stuff like that, but the call is my key one where I can get a lot of this sort of knowledge and information from, and that's where you can kind of piece things together. Again, I got a lot of shit on Twitter for getting long Nike, valuations, still through the roof, blah blah blah, consumer sucks. Well, yeah, but they're also Nike, right? And so it's like, okay, is their earnings going to be as bad? Maybe, probably, but I'm thinking also from a rebalance and like trade perspective, is it pretty easy, or certainly easier conversation telling your client that you're long Nike and you're not long Lulu, right? Or you're not long T-Doc, you're long Nike, probably, right? So, I like that. Again, it's a bit narrative, but it's a bit also the signal.
Yeah, no, I totally, and I agree with you. My mom, who's almost 70, she calls those stocks oldies but goodies.
Yeah.
Because no, it's like the old school, like, if you hired IBM as a consultant, you never get fired.
Right, exactly. It's like if you own Johnson, and I bet, and I get it, not bet, but like, the signal's improving on Johnson Johnson, it's improving on Coca-Cola, it's improving on Pepsi, right? It's improving on, some healthcare names, it's improving on some staples, right? So it's like, okay, yeah, I mean, it's exactly right? It's like, okay, like when stuff goes bad, to Brian, to if Muni Bonds was still on here, it's like, okay, those are the things that traditionally work. So if the S&P is down 20%, it's like, okay, well, yeah, but we've got a recent exposure to these core assets, and they typically work, when things, in a recession.
Yeah, totally. And to Nike, Crime Dog, maybe like 6 or 8 months ago, was talking about how they were essentially being threatened in China by, I can't remember the name of the Chinese company right now, but he said, like, they're not going to lose in China. So I think there's some validity there with the pod acceleration. If China's going to start picking up, it makes sense that Nike would have a little bit of pick up a little tail off that.
Yeah, no, that's one that Felix Wang likes too. It's I'm drawing a blank on the name right now, but yes, I remember, and that's definitely Pinduoduo is wrapping up your list. They trend. I think some of the consumer names I got to get a better handle on inside of China, because I think that's going to be a really good place to be.
Yeah, I just opened up a small position in Yum China. I think.
Yum C. Yeah, it's been a great one.
If you're getting out of lockdown, what do you want, man? You want pizza and wings?
That's right, baby.
What was that ticker again? Is it YMC on Yum China?
YUMC. So
YUMC. Thank you.
Yeah. Yellow, Uranium, Mary, Charlie. That's been a good one. I've been in and out of that. I don't really hold China positions for very long. I'm not going to lie to you guys. If I get 8% or 4% in Yum C, if I get 3 to 4%, I'm out like Flynn, and I'll revisit lower. So, especially in a phase transition, man, it's tricky because you can be up 8% one day and down 6 the next. So, it's China's, as I mentioned earlier, has some pretty serious volatility inside of it, even in staples like a Yum C. I mean, this thing is, that's kind of as clean as it gets, but it still moves pretty significantly. Not quite as bad as KWeb, but yeah. Anything else, Poke? You kind of brought some good insights there.
I wish I had something.
I know we covered a lot tonight. So
yeah, no, I was watching this morning. It was the relative bounce in Facebook. I thought it was really interesting how many shares traded so quickly in the morning, and then it obviously faded with the rest of the sector. But I think you're starting to see some. I think the next 10 days, like I agree with what other side was saying before and what Gavin was saying. Today was a pretty quiet day. I put on one trade. I put some put spreads on Meta. But it sounds weird to say that. But But the no, I'm just kind of waiting, right? I shorted some as I think it was, I don't know if it was Andrew was saying before, but I shorted some junk and some high yield yesterday. But I think it's just kind of we're just in this holding pattern because like this bounce is going to come, right? And you just the market, like you were saying with volume, volume's a tease right now, right? It's teetering right on that line where it wants to, at least my screen say it's teetering right on that line where it wants to give you kind of that green signal where there's going to be real force behind this move. So I'm probably in my trading account, I'm probably 75% cash right now, between 70 and 75% cash, and in my long-term non-taxable accounts, I'm probably like 40% cash. I didn't sell as much as I should have, full disclosure. But yeah, I'm riding some stuff out. And whoever said before, I own a little Playboy too. I didn't sell it either. Just for that, just so I could look at the screen every day and say, "You're an idiot for being down 60%."
But now you got to offset it with some like Playboy calls or something like that, right? Like longer dated. I was looking at, but good stuff, man.
I wanted to add here, Rob. So actually, I was looking at my models for JNK. I mean, from a setup perspective, I would
like junk.
I would not short it before 95, 33 to 96, 31. Those would be the two levels where I would basically consider as a good setup with relative good risk reward in your favor to go short on. Right here, JNK may not be the best spot to go short on. Now, obviously, things could always go from oversold to crash, but from a pure a priori probability perspective, right? Beforehand, not ex post, not after the fact, but beforehand, forward-looking perspective, I would not prefer shorting junk here. I would prefer shorting junk at 95 to 96.31.
Yeah, Trend, I totally agree. I got a little antsy yesterday as it was coming back in towards the end of the day. I thought maybe just in case like everyone's wrong and we just see this swoosh down after such a big open on on Tuesday. I put on a real small position in there, and they're at the money puts stated out till September. So if I'm wrong for the next 2 weeks, I'm okay.
Right. Of course. Understood.
Yeah, I would agree. That 95 level looks, that's where I get interested too. Yeah, for sure. At least currently, as of January 22nd. That might shift next week. Next week, but I just was flipping through my notebook. You probably heard that, but sorry. So I didn't realize I wasn't on mute. I was trying to see if we got any details from the last RTA live, but he gave our HYG. He was talking HYG rather than junk, so I just didn't know if he gave us the trade line. But yeah, that makes sense. I mean,
yeah, and on the same grounds.
I mean, Trend. I'd rather it at like 101. Trend, like if
Agreed.
Let's get it at 101, baby, and then it'll go all the way down to 70.
Yeah.
Anyway, sorry. Go ahead, Trend.
No, I was gonna just add that even on the SAS shorts, right? I would not be building shorts here on the SAS names. They very well may go down well below these levels, but from purely again risk reward perspective, right? I would want to sit out on these couple of weeks to hopefully see them go up, and then that would be a better place for a setup to build shorts, either through put spread or directly puts on some of the SaaS names, because there's still SaaS names which are out there with EV to sales above 10. Snowflake is one. Granted, it's like the granddaddy and king, and they have been delivering growth, and their CEO is pretty well disciplined. He's going to become FCF positive and whatnot, but still, come on, there's been a complete repricing of risk, and these guys are still trading at 15 times sales, so it will definitely be repriced way lower, at least like 30-40% lower from here. Would it happen right now? No, I would wait for it to.
I just pulled up that chart, the trend. Holy Nikes, that thing's going from 400 to 130.
Yeah. So from their from pure signal perspective, right, I would wait for it to get into that zone of 140, 145, that level, and then that's where I would pull the trigger on my on my side, especially the Snowflake short. Snowflake is a good company, by
140
the way.
though would be a 1 month high. I mean that's tricky, man. That gets into the momentum trade.
I know, and
that thing
that's
looks
where.
like that thing looks like it's about to break out. To be honest,
Yeah, so if that happens, right? So that's what I'm saying. That
I mean,
the risk reward there becomes extremely in your favor.
yeah, like one set again. I mean, I got trend closer to like 178 ish, right?
Yeah.
Yeah, and that's man, that would be again. No, I mean, but it's a perfect example, right? Where like if this thing takes off, like
Yeah.
let it breathe, and then get greedy, right?
Yeah.
I mean, I think
Yeah.
right, like that's your point, right? It's
Yeah,
like
that was the point I was driving.
patience and then
Yeah.
pounce.
Yeah.
Ooh, I should put
Not
that.
push it.
I should put that on a T-shirt. Trend patience, then pounce.
Yeah, patience and pounce.
Although that could probably be taken a little bit misconstrued,
Yeah.
but
And that actually applies to a few other names too. So there's another one called VRSN, which is very sign. This one actually doesn't grow as fast as Snowflake, but it still trades at like a bizarre multiple for no apparent reason. So this one, I'd wait for it to come all the way back to 175. And I know it again goes into that momentum part that you mentioned, but it actually, my stop loss on that would be 182, but I would wait for it to come anywhere between 171 to 175 and then press shorts on it. And the
what was that tick? What's the ticker again? Sorry.
Sure. V as in Victor, R as in
Yep.
Romeo, S as in
Got it.
Sam, N as in Nancy. VRSN.
Got it.
It's overall it's a decent company, just like Snowflake, but valuation is just still extreme in their case. So with shoes to drop that are coming through, these are some of the companies which are going to be vulnerable, even though they're good, and they're going to be super liquid. So you're going to get like good options liquidity, good stock liquidity, those kind of things.
Yeah, I like that. Good call out. I hadn't actually. VRSN wasn't on my radar for some reason.
Yeah, they have a pretty high EV to sales just on, and compared to their growth, right? They're not growing at Snowflake pace.
Mm-hmm. Yeah, no, good call out, buddy. Good job, as usual.
Thanks.
As usual. Awesome. Well, we'll if there's nothing else from the crowd, we'll wrap up. And thanks again for a wonderful night and another great notebook session. Hopefully, you guys got some good value out of it. And we'll see you back here next week on the 29th. It'll be an afternoon session, so 4:30 Eastern on the East Coast. And yeah, between then and there, best of luck. Stay patient, then pounce. I like that. I think that's a new tagline. Patience, pounce. I like that. Absolutely.
Yeah, and don't miss out on checking out Rob's interview with discussion with Nancy.
Yeah, thank you. See,
yeah,
you're like my hype man. Yeah. So we had a great one-on-one with Nancy Davis yesterday morning. It was about an hour, probably 55 minutes or so. Yeah, really, really good educational interview. We talked a lot about IVOL, but more specifically about just sort of the fixed income volatility space, derivatives. How she applies it. How she thinks about it. I've already, again, I'm not trying to, I guess, brag or whatever, but I've listened to it twice and I've learned different stuff both times. And it was a great conversation. She was very kind to give us give us her time really at the end of the day. So it was awesome. And I guess with that, I've also opened things up to listener supported kind of contributions. So if you're interested or feel like you get some value out of these calls, I'd humbly I'll be very humbled for your support. So thank you for that as well. And yeah, we'll
and it's Rob, actually, I think when you post this one and pin it, just post the link to that one.
Yeah,
I think we can all definitely support Rob for carrying out this amazing spaces and all the insights that we gain from each other out of this community, as well as think of overall from a community building perspective. Rob is helping us organize these almost in a very disciplined fashion. Every Wednesday we have a session, and I believe that we have had like some superstars come over here, right? We have had Heath come over here. We have had Mike Taylor come over here. We have had Nancy Davis, and quite a lot of them that have come up over here. So definitely worth supporting, Rob.
Well, thanks, Trent. I appreciate that. And yeah, no, just it's not going to shift the subscription or anything like that. It's just sort of listener supported. So yeah, again, I really appreciate it if you do have the ability to contribute. And yeah, so awesome, guys. We'll thank you, and we'll see y'all next week.
Thank you. Good night.
Night, Trent.
Thanks, Rob.
Night, Palmer.
Yeah.
Thanks,
See
bro.
you.
See you, Roland.